Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Trump's legal woes, Tim, not precluding financial elites from throwing their weight behind him. That's for sure.
Yeah, in fact, some financiers who abandoned Trump after his supporters stormed the U.S. Capitol on January 6, 2021, and kept their distance as he continued to claim falsely that the 2020 election was stolen, are now throwing their weight behind him again. Well, a big reason, Sri Natarajan is going to tell you all about it. He and Amanda Gordon write about the growing number of prominent figures in U.S. business and finance who are embracing the possibility of a Trump restoration. Criminal conviction be damned. Sri is Bloomberg News senior finance reporter. He joins us here in the Bloomberg Interactive Brokers studio. A big reason, in a single word, Sri, what is it?
Money. That is a primary factor here. Taxes, regulation, that has been something that has been a bane for the deep-pocketed Manhattan class, the deep-pocketed class of finance, and a lot of them are keen to go back to the Trump fold. Yes, they have rationalized it with other reasons as well, and those have been pointed out. Case in point being Steve Schwartzman, who came out and, a week before this guilty verdict said he's throwing his weight behind Trump, and it's a second U-turn for him. First he was a no, then he was a yes, then he left in 2022. But interestingly, Schwartzman highlighted growing tide of anti-Semitism as one of the reasons. But it's a good time to remind listeners that back in 2017, Schwartzman was the chair of that business council under the Trump presidency, and in the wake of the white supremacist rallies in Charlottesville, that committee was disbanded, and he tried to distance himself back then as well. And again in 2022. So it is really a lot of these people who have influence and sway who are coming together and trying to throw their weight behind Trump. Opportunism might be a reason. At least that's what we've heard from at least a couple of senior people we've spoken with. And it's hard to argue against that. If you've made the conclusion that you don't believe this is a dead hit, you're convinced that it is going to be a Donald Trump victory, then there is some benefit in jumping in early and saying you back Trump.
Okay, the taxes part notwithstanding here, but in terms of money, some of the folks who you refer to in your story, Steve Schwartzman, for example, if you were to ask them now if you're better off now than you were 4 years ago, a lot of them would say yes, at least financially, because they are a lot wealthier than they were 4 years ago. They haven't been hurting during the Biden administration, is another way to put it.
A lot of them perhaps should be saying yes. I don't know if they will say yes.
Yeah.
We spoke to Whitney Tilson. He was a former hedge fund manager, ran Case Capital Management, shuttered about 6 years ago, but still is with Stanbury Research right now. And let's be clear, his leanings completely on the left.
Yeah.
He can't even contemplate voting for a Trump, but he does make a point that for people in the investing business, the Joe Biden presidency has been extraordinarily good for them. Successive stock market highs, low unemployment, soaring corporate profits. So he says it's indeed puzzling how the very people who've done the best under the Biden presidency seem to be the most dissatisfied with this presidency.
Well, do you put that question to those that are big financial types that are now backing Donald Trump? Like, what is that? What is their response to something like that? Look at the last 4 years, whether it's the equity markets, whether it's the economic backdrop. It's amazing kind of the disconnect, or what are we missing?
Yes, but they'll also throw in other reasons, including inflation, rising deficit, the border situation, the handling of the Middle East conflict. So, and it's hard for us to sit here and judge that whose points have more merit.
Right.
And that is something we've avoided trying to do in the story. But what we're trying to point out is this isn't like 2016. This isn't like 2020. 2016, a lot of people sneered at Trump, especially the successful folks in New York always saw Trump as a bit of an outsider, the Queens guy, a real estate guy they couldn't be bothered with. They never expected him to win. 2020, you went through 4 really crazy years, to put it simply.
Yeah.
But 2024 seems to be a you know what? Maybe a Trump presidency is not bad. We've not had a seat at the table in the Biden White House. He doesn't seem to be leaning on the captains of the industry, especially the titans of finance, to how he should run the country. So if you're feeling left out a little bit in the cold, doesn't hurt to go in early and say, I will back Donald Trump.
Maybe even as a message to the current president.
100%.
What?
It's also interesting. I will refer listeners and viewers back to a April story from Amanda Gordon where she talked to John Polson, the man famous for big bets against subprime mortgages. She did a Q&A about why he is backing Trump. I would encourage everyone to go read it. One part that I found very interesting was the way that he spoke about January 6th. He said, I don't think January 6th was an insurrection nor an attempt to overthrow the government. It clearly was, though, a demonstration that got out of hand. I think people would have disagreed with that a few years ago.
How many months? 5 months? It's going to be interesting. No doubt about it. Shri, thanks so much. Important story we want to get to. Shri Natarajan, senior finance reporter here at Bloomberg News, right here in our Bloomberg Interactive Brokers studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
One thing that did happen, according to Donald Trump in his press conference this morning, supporters are sending in cash.
Last night, we just got a report this morning, in the history of politics, I believe, maybe I'm wrong, somebody will find that I'm wrong, maybe, but I don't think so. They raised with small money donors, meaning like $21, $42, $53, $38, a record $39 million in about a 10-hour period.
All right, everybody. Donald Trump this morning in his press conference from Trump Tower. So supporters sending in cash. Maybe more interesting in that statement is Donald Trump saying, quote, in the history of politics, I believe maybe I'm wrong. Somebody will find that I am wrong.
Which brings us to a column by Bloomberg Opinion senior executive editor Tim O'Brien. Tim writes today how Donald Trump has spent decades circumventing and flouting civil and civic society. He spent his presidency and the years since going well out of his way to undermine the rule of law, and the law finally caught up to him. And yet a more critical verdict is still to come. We welcome in Bloomberg Opinion senior executive editor Tim O'Brien. His books include Trump Nation, The Art of Being the Donald. Tim also faced off with the former president in a lawsuit that went in Tim's favor. Tim, by the way, talked with Trump for that book. Tim joins us here in the studio. You've tracked the former president for years, Tim, way back before he was even thinking about the White House. Many have talked about his ability to fight and win legal battles for a long time. You write it was long overdue for the law to finally win. Does it mean anything, though?
Oh, I think it means a lot of things. I mean, I think we're a nation of laws. Laws exist because all of us can be prone to bad behavior, even you, Tim. And and I think, and I think they enforce standards of civil and civic society. And I think Trump's never been brought into a courtroom with these kind of stakes before. Bob Mueller investigated him, but Bob Mueller chose not to bring him into a court of law. He said, I'll let the U.S. attorney handle it, or I'll let Congress handle it. He was impeached twice, but the Senate decided not to try him. And he got tried on the facts here. And there's 3 remaining criminal cases looming out there that are very muscular and substantial. Much more, in fact, than this case. I think this case was the weakest of the 4 criminal cases brought against him. So I think it matters that it's on a very, very basic level, rules and laws matter. He was judged by a jury of his peers, 2 of whom were lawyers. I think Justice Merchan ran an impeccable courtroom. I was in there for quite a bit of time, and he, under very challenging circumstances, he kept things moving along. And I think he got to a verdict that was built on a fact pattern. It wasn't a witch hunt. And it was clear as day. There were mountains of evidence that he was doctoring the company's books in order to mask payments to his former lovers to preserve his 2016 presidential bid. People can argue about whether or not those misdemeanors should have been elevated to felonies as part of the election interference charge, but the jury and the judge felt it did. Justice felt it did. And so we'll see where it goes from here.
You know, Tim, you remind everybody you wrote about him, you had access to him, you had access to his business world and his financials, right? I'm just curious what you learned in talking to him and about his world and how he does things, and what impact losing this case essentially might have on him, the individual.
Yeah, I first began covering him 32 years ago. I was a research assistant on the first biography written about him, and I covered him at the Wall Street Journal and later at the New York Times, and now here at Bloomberg. And I've spent a lot of time with him. And I think he's a very different person now than he was even 2 years ago. I think he's aged quite a bit. I think he's worn down by this process. I think when the verdict was announced yesterday, I think he looked shell-shocked. And I think everyone was surprised by the rapidity with which the jury reached a verdict, the clarity of the verdict, and the fact that it was every single count. And on 9 of those counts, he signed the checks that are at the heart of those accounts. So I thought he would be held up for something. I didn't think it would go to all 34, yet it did. I think this weighs heavily on him. And he's in territory he has never been in before, Carol. Yeah. You know, he's had run-ins with regulators in Atlantic City, with local government in New York. He's always weaponized the legal system against business and political opponents, members of the media. But this is the first time where he's really been held to account in a way that is potentially going to limit his liberty and circumscribe his future. And I think he is stunned and desperate.
And yet, there's a very good chance that come November, he could be president-elect.
Governing from a prison cell. And by the way, if he's in prison, if it were to come to that, the Secret Service would have to be accommodated. So you'd also have to have room at the prison for the Secret Service. The whole thing's mind-blowing were it to come to that.
You do think there's a good chance that the sentencing could include prison time?
I think there's a good chance. I think Justice Merchan is very circumspect. During the gag order rulings, he could have put Trump in jail. There were, 3 different hearings, I think, on that.
There are also 2 other individuals who have done jail time, right? I think about Michael Cohen and Mr. Weisselberg, right?
Yes.
That have related.
Who related all this, and I think Merchan wasn't going to put Trump in jail because he's a former president, because he didn't want to poison the atmosphere around the trial. But he now has at his disposal up to 4 years per charge. I don't think he's going to give Donald Trump 134 years in prison. The most they would run concurrently, up to 4 years. I don't imagine he'll go that far. I do think he's going to be more severe than people anticipate. That's his record as a judge, particularly on white-collar crime, which we always ask of our judges in many cases is to be strict around the crimes. But this is an unusual case, and we'll have to see.
How are you thinking about it politically? As you say, the final verdict may be to come, or the most important will come in November when people go to the polls. What does it mean? We can go into history and American political history, but I do think about the supporters of Trump, which he highlighted today, saying they're sending in money. But how are you thinking about that?
Well, and he, after he left the courtroom yesterday, he was the one who said, I was simply quoting him, the real verdict will be November 5th when the people speak. And I think that's true. And I think if he ends up going to prison, I think even if he's on probation and he's got to go in every day, for urine exams and get walked in and out of a courthouse and all the kind of demeaning things that happen when you're on probation, that is going to be detrimental to how he's seen in the eyes of the public. And this is not going to come down to blue voters or red voters and MAGA voters. It is going to come down to about 2 million voters in 7 states who are moderate to independent voters who I think care about institutions and the rule of law. And it'll be interesting to see what the impact this has on their view of him.
What I do find fascinating, Tim, and Amanda Gordon and Sri Natarajan write about this. We're going to be talking to Sri a little later about how wealthy Wall Street financiers who distanced themselves from President Trump following January 6th have now started again to rally around him. And you indeed have political opponents of the former president, like Nikki Haley, for example, who in recent weeks have
Marco Rubio
as well. We seem to be in a position where still he has support from the establishment, despite the fact that all of these challenges hang over his head.
Well, I think the calculus for the political camp is different than the calculus for the Wall Street or business camp. I think the political members of the Republican Party have recognized for some time that Donald Trump retains enormous momentum within the party, and that you have a very difficult time getting elected in the current Republican Party, at least in the primary season, unless you have Trump's support. I think what we're learning with the business community is I think they see all of politics as so shambolic and chaotic right now that they're wondering what are the public policy measures they want out of either a Democratic or a Republican administration. And it often boils down to very simplistic things: less regulation and lower taxes. And that sort of defines their imagination around what they want out of politicians. And unfortunately, it means that maybe they don't consider where we are vis-a-vis Ukraine, or how Gaza gets resolved, or how climate change gets addressed, or voting rights, or infrastructure spending that's good for the broader economy. I do think there's a real blinkered view of what politics entails sometimes from the business community. And I think they should recognize whether or not they're playing with fire. Is Donald Trump ultimately going to be good for the economy? He's pursuing policies, or at least his campaign has articulated policies that are inflationary, that will add to an already large deficit. Those typically have not been issues conservative business people want to get behind.
These are concerns that LinkedIn co-founder Reid Hoffman raised to us just a couple of weeks ago, who has been an opponent of President Trump's.
He has indeed. Tim, thank you so much. We
Thank
know
you,
a busy
Carol.
day for you. So
Always a
appreciate
pleasure.
it. Always a pleasure for us as well. Bloomberg Opinions Senior Executive Editor Tim O'Brien.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, "Alexa, play Bloomberg 1130.
You might recall our Bloomberg exclusive. We talked about this yesterday. The U.S. Slowing AI chip exports to the Middle East by Nvidia and AMD. We also recently reported on how ASML and TSMC could disable their chip machines if China invaded Taiwan. There's more. Another
Bloomberg exclusive. We should note that also the U.S. spending big time, thanks to the CHIPS Act, to build chip making here at home too, as our nations around the world to fortify their supply chains. China too, Carol, creating a nearly $50 billion chip fund to back its own domestic semi-industry firms.
There's a lot going on. With more on the oh-so-important world of semiconductors, with us, Michelle Giuda, CEO of the Krach Institute for Tech Diplomacy at Purdue. She is former Assistant Secretary of State for Global Public Affairs during the last 2 years of the Trump administration. She joins us from Hollis, New Hampshire. Michelle, great to have you back with us. There's so much going on, so much we want to get to. But we've got to ask you, as a former member of the Trump administration, do you believe the guilty verdict should exempt Donald Trump from being president again?
I will leave it to voters and what they say at the ballot box in November.
All right. Can I ask you, though, what would a second Trump White House mean for the business environment and for semiconductors and high technology specifically?
Look, the United States has a long-term plan to lead and compete in semiconductors and critical technologies, and so does China and other authoritarian regimes. And so I would expect a lot of consistency in whatever the future U.S. administration is going to be in terms of the U.S. prioritizing chips. As you had mentioned earlier, Tim, the CHIPS Act is a first move in really trying to catalyze U.S.'s ability to manufacture, to lead in R&D, and to work with many of our allies and partners in order to do so. So I expect that to be a long-term priority for the United States.
I'm wondering about how you think about China in terms of it being a threat when it comes to semiconductors. Certainly, we see the way that the U.S. government thinks that it could be a threat with the use of U.S. semiconductors. But if you think that China is a threat when it comes to its own semiconductors.
China has been very clear. Xi Jinping has been very clear that China wants to lead and compete and achieve self-sufficiency in semiconductors. And the big picture is, why do semiconductors matter? It's because they matter to anything that has an on and off switch. So that's regular everyday consumer products, but it's also the most advanced military products. And so it matters to us and it matters to them. And they want to be able to have the most advanced semiconductor manufacturing and capabilities worldwide in order to advance all of their strategic interests, which in many cases are antithetical to our own. And so they've prioritized it. This $48 billion that they've recently this round of funding that they're putting into semiconductors is actually just a freeze frame of their longer term plan. It's actually $140 billion, a 10-year plan. There is a chip czar in China. And so they've long focused and long prioritized semiconductors because it matters to so many technologies that matter to our national security and to theirs.
Is it safe to say that the world is awash in industrial policies at this point, that you're seeing it really around the world, whether it's the United States or China, something that they've done certainly for a long time, but we're not immune to years ago actually helping out the U.S. semiconductor industry at another time and era, if you will, but we're seeing it in Europe. Is that kind of the way forward that we need to think about, that nations are going to be investing deeply in industrial policy, whether it's for national security concerns or supply chain concerns?
It's a clear trend. I think it was Bloomberg who had crunched some of the numbers and found that about $380 billion by governments have been invested in semiconductors. And that's not only the US and China. Many of our friends and allies are investing in semiconductors. And that's really good news because there are force multipliers in making sure that these add up to our collective security and value. So the EU has a $46 billion plan. South Korea just last week announced that they were going to commit another $19 billion. SK Hynix, one of their leading companies, and so this isn't government investment, but SK Hynix, a leading South Korean company, just announced a big $4 billion investment at Purdue Research Park. It's one of the largest economic development projects in Indiana. We've seen TSMC now up to $65 billion investing in the onshoring here in the United States. And so yes, governments are investing, but so are companies too. And it speaks to the importance of tech diplomacy. Companies and countries across allies and partners are working together to make sure that we secure this technology.
What would you like to see more in terms of policy, especially when it comes to the semiconductor industry in the United States?
Well, we co-hosted at the Senate last month, the second annual CHIP Summit with Purdue. And we had almost every leading semiconductor company there, many partners and allies from across the world. And the number one thing that we talked about was workforce. And I'll just give you a stat here. There are about 345,000 jobs that the chips industry employs right now. There's going to be another 115,000 by 2030. At the current rate, 60% of those are going to be unfilled. And so we can invest as much as we want to in R&D, in labs, in new fabs, but unless we have the talent to be able to work in those things and advance the semiconductor industry, then it really doesn't matter. And so workforce capacity building that talent pipeline is as equally important as investing dollars.
Michelle, I want to go back to one of the exclusive stories that came from our team, Mackenzie Hawkins and Ian King, earlier this week about the U.S. slowing AI chip exports to the Middle East by Nvidia and AMD. And they write that part of the concern is that Chinese companies could access these chips through data centers in the Middle East, meaning that they could still use data centers, even if they're not on or in mainland China, because of the ability to access those via the cloud or through partnerships with other countries. Is that a real risk to U.S. national security?
Yeah, I think it goes to show how much that tech companies are just as much in the domain of national security as governments are. And so many of these technologies are cross-cutting and borderless. And so the United States is trying to prioritize national security. We've imposed many export controls and restrictions on these advanced chips going to China. And there might be other ways for them to get it. And so I think the U.S. is being strategic and careful to make sure that those advanced technologies and chips aren't getting in the hands of China, who want to use that to further their military ambitions and the People's Liberation Army. And so I think you see that happening here. And one of the reminders for the business world and for corporates is to remember that they do play a role in national security and our tech security. And we want to make sure, the United States wants to make sure that we're not, as they're doing business across the world, sacrificing long-term security interests for short-term profits.
Middle East, friend or foe of the United States, especially when it comes to high technology?
In many cases, they're proving to want to be a strategic partner, and that's where diplomacy comes into play. We want to make sure that we're working with them as we're partnering on critical technologies to make sure they're advancing our values and our interests. And that means data privacy. It means that they're helping, not harming human rights, that they abide by the rule of law, that they abide and respect intellectual property. And so I think there's a lot of opportunity for collaboration. There's a large fund in Saudi Arabia, I think just last week, that had said if the U.S. wants them to divest from China, they will.
Yeah.
And so there's a lot of opportunity for partnership, and the importance of tech diplomacy is going to make sure that when we partner on technology together, it advance our shared interests.
Michelle, just 25 seconds. Can we work things out with China in a better way? I mean, the pandas are coming back to DC. Panda diplomacy seems to be back. Is that significant, just quickly, in your view?
Pandas have played a key role, it seems, in diplomacy over the long term. Look, I think at the end of the day, the U.S. has been really clear, and many of our partners and allies, like the EU, like the Quad in Asia, on the values that we want to place front and center when it comes to our relationship with China, and specifically on technology. And that's up to China. Are they going to make sure that our cooperation on technology advances human rights and intellectual property?
Michelle,
it's up to them.
We got to run. Thank you. Michelle Giuda of the Krach Institute for Tech Diplomacy at Purdue. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
The Bitcoin halving, Carol, you remember. We talked about it a lot about 6 weeks ago because it happened a bit over a month ago. Just a reminder, it was a highly anticipated software update. It cut in half the so-called mining reward. It's the amount of Bitcoin released from the network to compensate companies known as miners for validating transactions. It potentially dealt a blow to the Bitcoin miners. One of those companies, Core Scientific, a publicly traded Bitcoin miner based in Texas. They've got operations all over the country: North Dakota, Kentucky, Georgia, Texas, and other states. Adam Sullivan is with us. He's CEO of Core Scientific, and he joins us from Austin. Adam, good to have you with us. Before we get to how you guys are doing post-halving, just catch us up on what's been a wild few years for the company. It declared bankruptcy back in 2022 when crypto prices crashed, but back in January, the company emerged from Chapter 11, and it's publicly listed once again. Give everyone an update.
Sure. So we've grown one of the largest digital infrastructure footprints since we were founded back in 2018. We built infrastructure leading up to what was planned originally to be over 2 gigawatts of power dedicated to the Bitcoin mining industry. Now, you mentioned our Chapter 11 process. In 2022 is an interesting year. We had Bitcoin price declining. We had a very sizable Bitcoin on balance sheet. But you also had the war in Ukraine, which led to higher energy prices across the globe. And so for Core, we really had a capital structure issue. It had nothing to do with our operations, capital structure, as well as the energy price movement, as well as Bitcoin. And so we went through our Chapter 11 process, actually had one of the most successful solvent debtor cases in history in terms of equity recovery. And now we're publicly traded. We listed on the NASDAQ back on January 24th of this year.
All right. So what's different about the business now, and how are things going since the halving?
The business is performing very well. So the Chapter 11 had nothing to do with our operations. Our operations, led by a data center-based team, has really led us to be one of the most consistent Bitcoin miners in the industry. I would say one of the interesting parts is post-halving, we expected to see more movement in the difficulty or how difficult it is to mine a Bitcoin. And what we've seen is we saw one difficulty adjustment lower, but in reality, the profitability today is still strong enough that a majority of the network has actually been able to stay online and continue to be profitable.
Hey, Adam, what changes have you made to your capital structure at this point to prevent another Chapter 11 bankruptcy situation from happening again if we were to see the price of Bitcoin crash again?
Yeah. So if you go back to 2021 and 2022, really a lot of the debt that was available was short-dated debt, right? And so because people didn't want to take that long-term risk on Bitcoin or Bitcoin mining, they didn't know what that risk profile would look like in 3 or 4 or 5 years. Going through the Chapter 11 process, we actually emerged with rather long-dated debt for this industry. We wanted 2 things out of our Chapter 11 process. That was time and optionality built into our capital structure. And so very limited debt service over the first 3 years, and then significant optionality built in. So via a warrant, a cash exercise warrant that would bring in $670 million, which would essentially eliminate our debt, and then also a mandatory convertible note. And so there's really 2 instruments in our capital structure where if we continue to perform well, we should be able to knock our way through each of those trigger points and actually eliminate all of our debt.
Hey, one thing I want to ask you, On Wednesday, your stock popped up about 5.5%. This happened after BITIG raised your recommendation or their recommendation on the company to buy from neutral. And they say it came with a couple of things. First of all, and I want to address this, expectations of a firming Bitcoin price, which it was Gregory Lewis, the analyst over there, which should allow the company to aggressively deleverage as warrants are exercised. So talk to us a little bit about that. What kind of insight can you come around that? And, what kind of Bitcoin price has to happen for that to happen?
I think it's really a give and take between network difficulty and Bitcoin price. So everything we think about is in hash price, which is actually a dollar denominated amount of revenue that we generate. But as Bitcoin price continues to increase, he mentions that tranche one cash exercise warrant, that brings us into a positive net cash position. And so eliminating all of our debt, putting us in a positive cash position, those are things where we're very close to those exercise prices. So that exercise price on that warrant is 681. I believe we're currently trading today in about the high fours. And so that type of optionality was what I was talking about earlier. It's a significant opportunity for us.
All right. And then the other component of it is that they're bullish on the opportunities that your company has for existing power capacity to be deployed in non-crypto data centers. Give us some thoughts on that and some color around that.
Yeah. So we announced in our Q1 earnings call that we're planning to dedicate about 500 megawatts of the 1.2 contracted megawatts that we have to HPC. There's an incredible demand in the market, especially as the power density of these new GPUs from Nvidia, from AMD, continue to come on market. It's not necessarily something that can be serviced by all these tier 3 data centers. And so this is where we have a significant opportunity to actually build a niche inside of the data center industry, and the scale of which would put us into the top 10 data center companies in the United States. And so that's where we're focused right now, continue to build out that part of the business. And our hopes is that over time, our investor base starts to realize stable long-term visibility into our cash flows actually brings a better valuation for the company.
HPC, of course, being high performance computing. Hey, Adam, I'm wondering about the power issue here that we're talking about. If you're going to be a data center provider for all of these companies and you're going to reliably mine Bitcoin post-halving, what's the cost that you're paying for electricity, and how do you keep that cost in control, especially given the problems that you faced a couple of years ago at the beginning of Russia's invasion of Ukraine, when energy prices spiked and led to the bankruptcy?
Yeah, so on the data center side, all of the utilities are passed through to our clients, and our power prices in these locations, when we first went to look for sites, what we looked for was low cost and abundant power. And so that provides us the opportunity, as these data center companies and as these technology companies are approaching us, to actually provide them with lower cost power than they would necessarily see at some of the other locations that they're looking at. Now, we had a low 4-cent power cost in Q1 of this year, and that's something that's still extraordinarily attractive for Bitcoin mining. But as we start to shift towards certain locations towards HPC, we'll actually be able to continue to bring down our all-in power costs at our Bitcoin mining facilities. And so that's something that gets us most excited about the opportunity.
But what about the stress to the grid and how that impacts maybe consumers generally who are just trying to keep power going in their homes?
Yeah, so our power contracts are all for 24/7 power. We choose to participate in certain power programs at different locations, and that's based on economics, based on profitability that we're determining based on prevailing market prices of Bitcoin, what the network difficulty is at that point in time. But we have the opportunity to actually move towards the 24/7 power contracts if we so choose. And that's something that the data center companies can choose, or the technology companies can choose what type of operating mode they would want to operate in. It depends on the types of programs that they're running at the facility. And also, what are the other things that they're putting at those facilities? So are there generators? Are there batteries? All of those different components can allow them to still participate in those intermittency programs that we participate in today for Bitcoin mining. But they can choose different types of products like those batteries to actually supply that power during times when they might lose power from the grid.
One last thing.
Go ahead.
Well, in terms of data centers, do you anticipate that that's going to be more of your business going forward rather than my question too, than Bitcoin mining? And just got about 50 seconds, because it sounds like it's a pivot, a big pivot. Is it?
It's definitely it's maximizing. I would say it's maximizing the value of our infrastructure.
No. Is it a big pivot though?
It's not a big pivot. We started it really as a data center business, right? We provide digital infrastructure initially to Bitcoin mining companies to host their machines. And now we're choosing to host HPC or GPUs and other types of compute for high performance computing.
For AI,
and so
right?
it's not a big shift for us as a business.
For AI. But it sounds like that part of the business could be ultimately your business going forward. Is that kind of yes or no?
It could be a big part. It will be a big part, but we're going to continue to find new assets to mine Bitcoin at.
All right. Just curious, because that certainly plays to the analyst call this week that had your stock popping. Hey, Adam, always good to get some time with you and get more insight into your business. Adam Sullivan, he's CEO of Core Scientific, joining us from Austin on this Friday.
I'm driving in my car. I turn on the radio.
Yeah, how about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, as we like to say, TikTok, everybody, 18 minutes, under 18 minutes left in the Friday trade, getting ready to wrap up today, wrap up the week, wrap up the month of May. It's been an interesting one. Bullish for stocks, but it also looks like Treasuries actually have had a pretty good run here this month. I think the best one here in 2024. So let's get to it. Let's talk a little bit about the trade.
We got John Mowrey with us, Chief Investment Officer at NFJ Investment Group. They've got about $6.4 billion in assets under management. John joins us from Dallas. John, happy Friday. How are you?
Yeah, we made it through the storms down here so far.
That's good to hear. And we've made it almost through the month. So
yes,
we
can
all appreciate that. A lot coming at us.
A lot coming at us, exactly.
Hey, talk to us a little bit about what's on your clients' radar right now. When they pick up the phone and call you, or when they send you some frantic emails late at night, what are they saying?
I think that inflation and the rate at which that's coming down, and then subsequently what the Fed's going to do with interest rates, has definitely been on everyone's minds. And, the reality is inflation can be really a pretty regressive tax on Americans. But the reality is the interest rate policies have also been pretty challenging in terms of how that's affected the smaller and medium-sized companies. And that's been masked in large part by the Mag 7, the AI trade. But below the surface, there's been a lot of challenges in the small and medium businesses. And I think that's been just a concern for the overall economy, as well as when those areas might be more rewarded in terms of a revaluation.
All right. So if I just do a quick, easy comparison, the S&P 500 up about 10% so far this year. You've got the small caps up not even 2%. So are you saying that you're finding opportunity when it comes specifically to the small cap space, and you would suggest investors allocate some new money there?
Absolutely. I think that some of the areas that are most interested are some of the equity income oriented areas of the market. And there's a reason that they're cheap. If you think about, where investors can plow capital today, you can have a risk-free rate on the short end of the curve at 5, or alternatively, you can hop into the NASDAQ and you have fast growing companies. And again, that AI trade. So there's been a whole area of the market that's been kind of goalied out, if you will. And that would be some of the banks, some of the REITs, the utilities. These areas have been directly impacted by the interest rate policy, and they predominantly sit in some of the smaller and medium-sized areas of the overall U.S. capitalization. So we do see opportunity there. The question would be, well, hey, if those areas have been hurt by higher interest rates, when do you see that becoming more of an opportunity in terms of lower interest rates? And the reality is, when I look at the Fed funds rate relative to the 2-year bond yield, that is one of the widest spreads going back to the 1980s. So the bond market has been signaling to the Fed to lower interest rates. They've been reluctant to do so, understandably. But nonetheless, I believe that does create an opportunity for investors that want to have a little bit more of a longer term time horizon and get into those areas, in many cases, that are the cheapest since actually going back to the dot-com era.
All right. So you came to play. You gave us, our producer, Paul Brennan, a couple of stock picks. So let's get to it. Although I find it interesting, having looked at them after saying that you find opportunities in the small cap universe, that none of these are small caps. So maybe you can kind of start there. Alexandria Real Estate, it's a REIT that you like, an office REIT. It's down about 7%, but it isn't a small cap. It's over 20 billion market cap. So first of all, explain that disconnect, because you're saying you like small caps, but these are certainly larger.
Definitely so. So I would say that where we're seeing the opportunity would be in the small and mid areas. This would fit squarely in that mid cap arena.
Okay.
I mean, you think about these companies like Nvidia when you got into the trillions. These are pretty small by comparison, but nonetheless they are more in the mid cap space. Although FFIN at $7 billion is a little bit smaller. But Alexander Realty, just to touch on that is an office REIT. And when you say the word office, that's a little bit of an unnerving comment when it comes to REITs because of what occurred post-COVID. But this one's different. 98% collections, and that's because their tenants are pharmaceutical and life science companies. They can't easily relocate. They're on the East and West Coast near universities. And as you can imagine, you can't just up and move a laboratory like you can traditional office space. And Alexander Realty is actually growing its dividend faster than the rate of inflation, yielding over 4%, and the multiples below where it was in March of 2020. Imagine if you could get in a time machine and go back and buy stocks trading at where they were during COVID. And the reality is you just have to do it in some of the less popular areas like an Alexander Realty.
So the question that I have is what you want to avoid right now. Where do you not want to be?
So specifically with the REIT area, I think that you have to be very cognizant of some of the traditional office REITs. I think those are under pressure. There's no question that we have structurally changed how folks are going to be going in and out of the offices, and that's going to create challenges, particularly for those REITs that borrowed at very low rates. They need to do renovations to get folks back in, and it's going to be hard to do that if you have folks that are cutting office space. So I think those are going to be very challenged. And then on the other side of the equation, I have a bank on here, FFIN, First Financial, bank shares. I think regional banks do look very interesting to us. And if you take a step back, you think, well, is that a problem that the yield curve is inverted? And the answer is yes, it is a problem long term, but in the near term, it can create significant opportunity. If you rewind the clock back to 2000, which I think is appropriate given that valuations are back to those levels for many of the REITs, banks, as well as utilities. The yield curve was also inverted. And as it unwound coming out of that dot-com era, you saw significant outperformance in some of the regional banks. So the regional banks that I think folks should be interested in are those that not only are pinned to net interest margins, but also those that have some wealth management. And those recurring fees are going to allow them to better weather a challenging yield curve environment.
Okay. You mentioned utilities, so I want to go to one of your other picks, American Water. It's up 3% today. It provides drinking water, wastewater, and other water-related services in multiple states and Ontario, Canada. Talk to us about, just in the last 45 seconds we have with you, why you're bullish on American Water.
And talk about dividend growth. That's pretty impressive.
Yeah, so the dividend growth here at over 8%, again, more than double the rate of inflation. Very impressive, yielding over near 2.2%. This, again, is trading at the lowest multiple in over 7 years. And as you can imagine, utilities were the most hurt by higher interest rates relative to other areas for two key reasons. The first is that everyone thought we'd go into a recession in 2023, so they overpaid for utilities in 2022. And then as the Fed raised rates, those yields became less attractive, as well as concerns about refinancing. Now you're in a position where you've got significant dislocations in the valuations, growing dividends, growing earnings, as well as a lot of the infrastructure package should bode well for some of these companies like American Water.
Well, great to check in with you. Love talking names. John, thank you so much. John Mowrey. He's Chief Investment Officer at NFJ Investment Group.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.